There's a pattern I've seen play out hundreds of times over 28 years of working with business owners. Strong income, successful company, and a net worth that doesn't match either of those things. And when you dig into the why, it's almost never about how much they're making. It's almost always about what they're buying. And when I say poor, I don't mean income, I mean wealth building behaviors. That distinction matters for everything that follows. Specifically, there are 8 types of assets that keep showing up in the financial lives of business owners who are stuck, owners who are doing great on paper and quietly losing the wealth building game. A few of these you would expect, but asset number 4 is one of those that surprises almost everyone, and it may be closer to home than you think. In this video, I'm going to walk you through all 8, what makes each one a trap, why smart people keep buying them anyway, and what to do instead. And before we're done, I'll leave you with 8 questions you can take a screenshot and use to look at your own situation today. Stay with me for that. But before I list them out, I want to give you the lens I use because it changes how you look at everything that follows. This isn't about what business owners are doing wrong on purpose. It's about what most of us were never shown in the first place. I include myself in that. I was running $1 million plus revenue practice, doing well by most measures, and I had a chance conversation with a bookkeeper while I was in Costa Rica, of all places, and she laid out exactly what was sitting idle, what was getting reinvested without a real plan, and what those decisions had quietly cost me over time. I thought I had a handle on my own financial picture. I did not. That conversation changed how I thought about everything, and it's shaped how I work with clients ever since. Most business owners evaluate assets the same way. Does it sound credible? Did someone I trust recommend it? Does it feel like what successful people do? Those questions do matter, but they're not enough. Here's what I start with instead. Liquidity. Can I get this money out when I need it? Tax efficiency. What does this actually cost me after tax? Wealth building. Is this moving me towards financial independence or just adding complexity to an already complex situation? These 3 filters are exactly what we use in the TriBox system. Cash, protection, investments. Everything we do runs through them, and they apply here just as much as they do in any financial planning meeting. Here's the blind spot that's specific to business owners. Your business already has complexity and illiquidity baked into it. When you add more of both outside the business, you may be doubling the risk without doubling the revenue. So I want you to hold that filter. It applies to every asset on this list. Let's go. Asset number 1, cash as a strategy. The default with no ROI, no rate of return. I'm starting here because it's one of the most common patterns I see and one of the least visible. I can't tell you how many business owners I've sat across who have 300, 400, 500 sitting in a business checking account. Hasn't moved it in years, not allocated, not earning anything meaningful, just sitting there because it feels safe, because it feels like cushion, because it feels responsible. A medical practice owner at 1.6 million in revenue, over 580,000 sitting in the operating account. When I asked what the plan was for it, the answer was, that's my buffer. That wasn't a buffer. That was a decision that hadn't been made yet. One that was losing ground to inflation every single month while generating no meaningful return. And in some cases, idle cash held inside the business can create unnecessary tax exposure on top of that. Now, your CPA can walk you through whether that applies to your situation. Here's what that cash is actually doing though. Nothing, and nothing has a cost. Cash in the business isn't a strategy. It's the absence of one. Wealthy business owners figure out exactly how much the business needs to operate and put the rest to work in a way that they can still access the money and still be tax efficient. The difference between 2 decisions compounds quietly year after year. And speaking of things that feel smart on the surface, asset 2 is gonna step on some toes. Asset number 2, real estate, the business is quietly subsidizing. I respect real estate as an asset class. Done well, it can be a meaningful wealth builder. But I've watched business owners buy real estate for all the wrong reasons, emotional, status. Everyone says you should own real estate and end up using income from their actual business to subsidize a property that isn't carrying itself. That vacation home that costs twice what they projected, once you run the insurance, the taxes, the maintenance, and the management, the appreciation play in a market where the cash flow numbers never penciled. The deal they bought because a friend made money, something similar to years late earlier. Real estate is a good investment, and this specific property makes sense for me right now are two completely different questions. The ones who build lasting wealth treat real estate like a business, cash flow from day one, return on equity calculated before the deal closes, losses cut early when the math stops working. And here's the compounding problem. A business owner with an illiquid business and illiquid real estate has doubled down on an exact risk they're already running. The filter applies here more than almost anywhere else on the list. Asset 3 though is different. This one usually comes with a free steak dinner. Asset number 3, the product that came with a free steak dinner. Variable annuities, complex index products, whole life insurance sold as an investment vehicle. These show up constantly in business owner portfolios because they're sold aggressively and because the pitch sounds reasonable. Guaranteed income, downside protection, tax deferred growth, all things a business owner actually wants. But here's what might be happening inside some of these products. Layers of fees, surrender charges that can lock your capital up for years, limited liquidity, and returns that may not match what was presented when the steak was still warm. The business owner version of this trap is specific. You tend to get pitched these products when the business is doing well and the message is, you need to protect what you've built. That's not wrong. The product attached to that message sometimes is. Listen, complexity in a financial product often benefits the seller more than it does the buyer. If you can't clearly explain what you own, what it cost you, and what you can get out of it, that's worth examining before you sign anything. Now, asset 4, this is one I want you to stay with me because it's the trap that looks most like a virtue. Asset number 4, reinvesting into the business as the only plan. Now, for a period of time, reinvesting back into the business is exactly the right move. Pour back in, grow it, keep compounding. That logic is correct until it becomes the only move you know how to make. At some point, and it happens quietly without a clear signal, having everything tied up in the business stops being a growth strategy and starts becoming concentration risk. The owners who never recognize that shift, end up with 90% of their net worth in a single illiquid asset that requires them to show up every single day to protect it. I want to tell you about a pattern I've seen because it's one that stays with me. A business owner, strong operation, every good year, she's reinvested back in. Made sense. The business was growing, but there was no retirement plan, no outside wealth being built in parallel, just the business. And the plan was to sort it out all later. Then her husband passed away. And in that moment, when everything changed at once, she looked at what she had outside the business and there wasn't much. Everything was tied up in a company that still needed her to show up every single day to protect it. At the exact moment in her life demanded something different from her. The business wasn't the problem. The decision to make it the only plan made quietly over years without ever feeling like a decision at all. That's what made an already devastating moment so much harder for her. Reinvesting into the business isn't the problem. Making it the only plan is. The ones who get this right, they run 2 tracks simultaneously. They grow the business, they build outside at the same time. The ones who only run one track find out what that cost them when it's too late to change it. The business owners who start building outside wealth early, they have options when life changes. The ones who didn't are still waiting for the sale that will take care of everything. That's not a small difference. That is the whole entire game. If this has you thinking and you have questions that are better for a conversation than a comment, there's a link below to set up a 20-minute chat. Let's keep going. Asset number 5, the write-off that isn't as free as it sounds. Luxury vehicles, boats, club memberships, justified as business expenses, funded with business cash, rationalized with 4 words. It's a write-off. And here's what a write-off actually means. And you're in a 35% bracket and you spend $100,000 on something, the deduction may save you $35,000 in taxes, depending on how the expense is structured and whether it qualifies. Your CPA can confirm what actually applies in your situation. But even in the best case scenario, you still spent $65,000. A write-off isn't free. It's a discount on a purchase you may not have needed in the first place. And one good year shifts the spending floor. That floor almost never comes back down. The ones who build real wealth buy appreciating assets and they rent the depreciating ones. They don't use its deductible as a primary reason to buy anything. That's the line that separates a tax planning approach from a spending rationalization. Now, before the last three, quick question. How many of these 5 are sitting in your portfolio right now? Drop the number in the comments. I read all of them. Asset number 6, it's different. This one isn't something you bought. It's something that may have never been looked at again after year 1. Asset number 6, the retirement plan nobody revisits. This one's a sin of omission, and it's different from every other asset on the list because the problem isn't something you chose, it's a default that was set years ago and never revisited as your business grew. A basic SEP IRA set up in year 2. A solo 401k that made sense at $300,000 in revenue, but has a ceiling now. Or nothing, because it kept getting pushed behind everything else the business needed and another year went by. So here's something most business owners at this level have never been shown. Depending on income, age, number of employees, and how a plan is designed, it may be possible to contribute significantly more than the standard limits into a tax advantage retirement account. Current IRS contribution limits, subject to change of course, allow for structures that most business owners have never explored. As an example of what might be possible in the right structure, I've worked with clients contributing upwards of $300,000 annually across the combination of 401ks and cash balance plans. Now, whether that structure makes sense for any individual situation depends on specific factors your financial planner, a CPA would need to evaluate together for you. But every year this goes unaddressed, the gap between that being sheltered and what might be available keeps growing. Clients who've crossed this threshold don't set a retirement plan once and forget about it. They revisit that structure as the business continues to grow. The trap isn't the account type, it's the default plan that fit year 1 sitting unchanged in year 8. Now, asset 7 usually arrives through a text from a friend with a deal you need to hear about. Asset number 7, the private deal a friend sent over. Business owners get pitched private placement syndicates and friends deal more than almost anyone else. You're accredited, you have capital, and you respond to referral dynamics. This is what successful people are doing, is a powerful line, and it gets used constantly. The trap isn't the investment category. The trap is layering illiquid on top of illiquid. Your business is not liquid. Your real estate might not be liquid. Now you're adding a private deal with sometimes a 5 to 7 year lockup with no secondary market. A construction business owner, strong revenue, committed $400,000 to a private deal from a golf contact without ever mapping his overall illiquid picture. 12 months go by, the business hits a slow stretch, and he's got a receivables gap. The capital wasn't available. And most of the business owners I talk to spend more time evaluating their last hire than they did evaluating this last private deal they actually wrote a check for. Before committing to any illiquid investment, the question isn't, is this a good deal? It's what does my overall liquidity picture look like if I add this to my portfolio? The ones who build lasting wealth answer that question before they ever write a check, not after. And asset 8, this is the one that makes all the others possible or keeps all of them in place. Asset number 8, the advisory model built for someone else. So the last asset on this list isn't a product or an investment. It's a planning model. And it's one many business owners are paying for without realizing it wasn't designed for how they actually operate. The model built for a W-2 employee, annual reviews, investment management focus, limited coordination outside the portfolio, works well for the situation it was built for. The problem is when that same model gets applied to a business owner whose financial picture includes an entity structure that may need reviewing, a retirement plan that may need upgrading, a CPA who needs to be coordinated with, and planning windows that open and close throughout the calendar year. I see this consistently. A business owner at strong revenue working with an advisor who hasn't looked at the entity structure, hasn't explored retirement plans, isn't coordinating with their CPA. The advisor isn't bad. The model isn't built for the complexity of the situation. The right planning model changes every other asset on this list, not because the advisor isn't smart, but because someone is finally looking at the whole entire picture at once. That's what closes the gap. That's the model we've built at Tribox. I'm a business owner, I'm a certified financial planner, and our planning runs in quarterly sprints organized around 3 pillars, which is where the name comes from. We help clients think through cash flow, we help them protect and grow what they've built, and when those 2 foundations are in place, they can approach investment decisions from a position of clarity rather than pressure. Cash, protection, investments. We're not CPAs, we're not attorneys, but we make sure those relationships are coordinated so the tax plan, the legal structure, and the financial plan are all working from the same picture. That's the quarterback's role. The question isn't, do I have an advisor? It's, is my advisor's model built for how I actually operate? Now, if the answer isn't clear, every other asset on this list becomes more likely to stay in your portfolio. Before I let you go, here's your checklist. Screenshot it. If more than 2 of these landed, it may be worth a real conversation. If this sparked questions and you want to connect about them, reach out using the link below, set up a 20-minute chat. I'm here to help whether it makes sense for us to talk further or work together or not. I enjoy these conversations and I appreciate you watching. And if you want to go deeper on the tax side of what we covered today, watch the next video. It covers the tax strategies most business owners at this level have never seen and how they can change what you actually keep, linked right here. And if you like this video, subscribe and hit that like button so I know to make more content like this. And lastly, which of these 8 is sitting in your portfolio right now? Drop the number in the comments below. I'm John Rojas, and I'll see you on the next one.